Welcome to the catch-up call. I'm sure unprecedented times we are going through, but surely the challenge, the mood of the market and everybody's mood, I'm sure today is far better than yesterday. But good to have you guys here. And over next, 15-20 minutes, we'll try to give you our perspective about how we are thinking about markets, what's our assessment of the situation, and at the end of it, happy to take some questions, answers. Like usually, Budhat, I always enjoy chatting with all of you. So let's get into it. So clearly, this is not unusual situation. We've seen an aggressive stance post reciprocal tariff implemented by President Donald Trump, and the post World War II, whatever the order was there, today is being in some sense questioned, challenged on the world trade setup. And one can go into rights and wrong of it, but that's not, I think, mandate of ours right now. Right now, we should just take the assessment of the situation, what it is, what could be the potential implications of that. So we think that real war is or real challenges between US and China. I think US has huge current account deficit vis-a-vis China, and China is asserting the control, trying to be challenging the superpower status of US, and all those things have led to that. Now, some part of it, I think, the sentiment from US is also right, that because I think US economy has been struggling and a lot of jobs have moved away. So, two things which, Donald Trump has taken up. One is that he wants to cut wasteful expenditure, which is, or the excessive expenditure, inefficient expenditure by the government, which is where the Doge came into play, and Elon Musk is leading that. And second is that he wants to kind of bring back the manufacturing uh, back home, and partly also boost tax revenues by levying tariffs. So I think these are the two hand objectives he seems to be having now. First of all, whenever any government spends large part of the cuts large part of the spend, obviously it goes into the economy, which has an implication on the growth. And second one is, when you levy significant tariffs, it ends up being inflationary. And when you look at combinations of inflation, of course, aggressive inflation reduces the demand. So both could be in some sense impactful on the demand. But the counter to that is that if both of them leads to reduction in the deficit at the federal government level, then it can pave the aggressive rate cut cycle. The key challenge is, while all these things is being done, the path is a challenge, because the growth slowdown happens first, and then the interest rate cut can come, right? So that is the biggest worry markets right now at this point in time had, and that's when we saw kind of reaction we saw over last couple of days in markets across the globe. And more importantly, I think the real challenge is in terms of how many countries came back and announced retaliatory tariffs, and some bit of a got a little bit. I mean, we have seen ugly kind of exchange messages between. I mean, President Trump messaged or whatever, tweeted that if they don't take away the retaliatory tariffs, then we will even more 50% will be levied. So I think this is kind of getting a little bit of, I don't know whether I can call it a ego clash, or I can call it the aggressive stance, whatever we can call it. But I think there is a little bit of aggression which is going on in public spat between two countries. And I think by and large, I think Europe has come around, Japan has come around, most of the countries have come around to talk to US, saying that, we will kind of have negotiation and we'll talk and work around. Some countries have already reduced their tariffs. Fact of the matter, I mean, while all these things is fine, fact of the matter is that US can't manufacture a lot of goods because there's no labor there, and the cost of labor is also very high. So, I really don't know whether manufacturing can really be moved back to the US. So, hence, I think, how does the aggressive tariff will help? I have no idea. But fact is that I think it's just that, in my opinion, a little bit of settling of the current account, basically posturing and being pushing, pull and push is happening. So, my sense is that all these things will keep on creating confusion, noise in the market. We don't know. I mean, one potential outcome could be very clearly that, after an aggressive posturing where everybody is kind of, it has created a stir in the whole, market, whole world, and everybody suddenly alert to say that, Trump is serious guy and everybody needs to come back to it. Otherwise, he can be disruptive. And so that kind of environment has been created. My sense is that most countries will come, sit on the table, come around and do some negotiation and get away with it in next couple of months time. The real issue to watch out is what happens between China and US. That we don't know yet. I think still, we'll have to see over next course of next couple of days. But I think that is something really, really a big worry, where which will keep markets on the tenterhook. But I think look, we don't know what will be the broader uh, outcome, because these are all not a short term. While it is happening right now, but it's not a short term trend. It is over next couple of years. It will play out as the presidency progresses, as he implements a lot of cuts in his expenditure and implements tariff and try to boost manufacturing locally. We'll have to see that whether it is really he is really able to kickstart the investment cycle in US, because US badly needs to start investment cycle. The most infrastructure in US is crumbling, and for that they don't have money. Debt is ballooning, interest rates are high. So at this kind of interest rates and debt, you can't really have investment cycle. So the key objective, according to me, Trump is trying to bring interest rates down, start investment cycle, and thereby at least uh, have a little bit good growth in the US economies over next couple of over next few years. So the real point is that the transitionary period is something what one has to, and all of us have to worry about, investors. Eventual outcome we will see later, but I think right now we don't have any answer. We are not US experts, we are not global experts. We can, as much as we can try and guess, we can't get into really, these are all so many complex interrelated issues are there. When you think about global macros, you can't really make out. The only thing I think, in my opinion, as a rational investors, we can do sit now is here that what does it mean for India? How does India remain sort of placed in this overall chaotic environment? What are the potential positives and negatives for India? And accordingly, decides our investment strategy, right? So one single most, I think, in my opinion, I would say, like we just set the context that US environment, I mean, the global environment for some more time, whether it is next 1 month, 2 month, 3 month, at least looks like 2, 3 months, it will remain noisy, it will remain chaotic. Every now and then we will get news flow. One day market will be up, one day market will be down. It's kind of going to be like this. So we got to live with this. And accordingly, we should at least position or create our positions or create our emotional readiness to handle that at least for next 2 to 3 months is my view. Now, second thing is, let us look at, how does India place in overall, sort of thing, right? Uh, See, one of the great news, I think, vis-a-vis US, see, India's trade or goods export vis-a-vis other places doesn't change. But two things are happening. One is that India's export to US is very small. It's not a very large number. It's less than 2% of GDP. Secondly, more importantly, you know, if you look at our tariff rates is lowest amongst all our competition, whether it is Vietnam, China, Mexico, anywhere, we are the lowest amongst the set. So if assuming that US goes ahead with the tariff implementation across the board, US will not be able to manufacture overnight. So somewhere they will have to import from. India will be cheapest in that context, adjusted for the tariff. So in some sense, the tariff policy, assuming it gets go ahead in the current context, India still tends to benefit on that. India's tariffs are far lower than most of our competition, and that's a good news. Secondly, I think our leadership also is far more positively, sort of positioned. Our political leadership is far more constructively positioned vis-a-vis US. We all know that what is the relationship between President Trump and Xi Jinping, and President Trump and Narendra Modi, right? There is a sort of at least softer aspect between our leadership and US leadership, and of course India is not threat to US as well. So I'm sure there will be lots of discussion, backdoor channels happening, and US will get into bilateral a trade agreement with us and with many countries. So India is right now working at a very rapid pace in having bilateral trade agreements with Europe, with US. And Europe also, there's an urgent need for, as far as Europe is concerned, so far they were slow in terms of doing BTS, but now Europe also has become very agile in terms of doing BTS with many countries, including India. So the way I see is that India will conclude BTAs, in next, a few months or 1 or 2 quarters. I don't know how long it will take, but at least there's a lot of whatever based on our intelligence, our discussions, in a lot of backdoor discussions are happening on aggressive basis to arrive at a conclusion, and so that the disruptions are the least and the disruptions are, sorted out quickly. That is something very, very, sort of good news. But again, that's a process time, whether it takes 1 quarter, 1 month, nobody knows, right? These are the whole open-ended item. But net good news is that India is net beneficiary of this current ongoing situation where, and our same other thing remains, our cost of labor is lower than China. Our cost of, capital has come down significantly. India is giving huge amount of PLIs to boost manufacturing. So I think our core competence in the sectors like, auto components, specialty chemical, garment, textile, capital goods, pharmaceutical, all those, continues to remain. And, India's strength of exporting in batches, not specialty basis, not the large. China stands out in large scale, bulk volume kind of manufacturing. India specializes in, small scale customized manufacturing, which continues to remain as a strength. So we don't think there's a major threat from a structural point of view. Can can these lead to short-term disruptions? Answer is very much yes. There's no doubt, because what happens is that, let's say, I am supplying to some player in US. Sometimes, let's say, I'm sure in expectation of these tariffs being levied, some buyers must have preponed their purchases, and those numbers might have got captured into, let's say, last quarter. And as this crisis is going on, the numbers might slow down, or exports might not happen. But that does not mean any structural change. It might happen that 1 quarter numbers might not come out, 1 quarter growth might be very low. So those kind of disruptions can happen, and that happens many times. We have seen that happening in, when there was a lot of logistics challenge post pandemic, and during the Ukraine war also, where logistics were not available. The reason why chemicals, post 22 did not grow, because in 21 and early part, the whole of 21, a lot of stocking happened, and so everybody was fully stocked up. Hence 22 was kind of very low growth for entire industry, right? So those kind of happens because when there are short-term disruptions which is happening. Now those, let's say, assuming Q1 numbers come bad, markets will react thinking whether it is a structural change or not. So those kind of things we'll have to deal with in next 1 or 2 quarters. Uh, and every time you will sit back, is it structural? Is it temporary? Right? Our view is that the way India's position is sort of in its manufacturing, especially vis-a-vis US and other parts, it's not structural. But having said that, you really just don't rule out anything. You have to keep your eyes open, keep watching trends, keep watching data, keep listening to it. But at this point in time, our assessment is that nothing materially is negatively changing for India, given the fact that our tariffs are lowest as compared to our competition, given the fact that our relationship with the US is, if not favorable, at least neutral. So, versus China's, let's say, a little bit more, negative side, or a little bit more adversarial. So I think we are in that sense reasonably well positioned. So India tends to sort of benefit from ongoing situation everywhere else. Now coming to look at another interesting thing part is that our economy is very well placed. I don't think there's any other economy which can claim to be in such good shape, because there are major. If you just look at 4 or 5 big macros which determine the economy, India is solidly sort of supportive. Our current account deficit is less than 1%. And that's the reason every time there is a big volatility happens, we tend to still remain stable and solid. Even when markets fell other day, we were kind of holding very well. Right. So India is, our current account is very solid. We don't get impacted because of the short-term capital need, right? I mean, I remember in 2012 when India was part of Fragile Five, our current account deficit was 4.5%, right? So, even taper tantrum talk disrupted our market and economy, and currency depreciated by 20-25%. This time around, the interest rates have gone up by 5% and Indian economy is holding pretty solid. The reason being our current account deficit is very less and we don't depend on, foreign flows for our normal growth. And that's a very big thing. Second, our fiscal deficit is very well in control. Government is not overly borrowing. Tax collections are very robust. Government is ability to spend on infrastructure and everything else is fairly robust. So I think that part is good. Third is our banking system is very, very sort of clean, 0.5% NPA, very well capitalized. We don't need have any worry about in terms of, we can grow. And our monetary policy capacity is far underutilized. We have seen in last 2 years, RBI was fairly tight in terms of their monetary policy, but the new governor has Aate se he has reduced interest rates. He gave a stance that we are moving away from inflation targeting to growth. 4% inflation target to 4 to 6% inflation target. So that pivoting of RBI is very, very important in terms of monetary capacity, how much India has. If the environment were to kind of remain hostile, India can use its monetary, policy for supporting or boosting the growth, which we think will be seen soon. Tomorrow's the monetary policy. I would be very, very, hopeful of a cut tomorrow. More than the cut, I think the commentary will be more important. Thirdly, I think our corporate debt to GDP or debt to GDP, everything is, I think, very, very well in the control. We are on the debt to GDP basis, one of the lowest in the world. Our corporate debt is not very high. So our corporates are also very in a very good shape so that even environment turns out to be hostile, they will not stare at a kind of bankruptcy kind of situation. Of course, growth might come down, but at least they are in a good position to hold themselves through the thick and thin. And lastly, inflation is well managed. In fact, the fear of global slowdown has brought down the commodity prices and the crude oil prices, which in turn helps India, in reducing further inflation and cost of manufacturing. So I think that's again augurs well, again giving further the more leverage on the monetary policy side. So I think, this is again a very good setup for India because we are net importer of the commodities, whether it is crude, energy, of course, for sure. Even other commodities we are importing. As India is building infrastructure out, cost of building infrastructure also goes down because commodities are very large part of the infrastructure. So all those things again, like I said, that quite positive. Indian macros are solid in the pink of health, and there are no challenges as such. So I think if we have that context that India is well positioned, then if you just see and again dispassionately examine that, how does, let's say, take a company like ICICI Bank or like a Kotak Bank or take any, how their life changes just because US tariff is implementing tariff and it has whatever the challenge was. So there are many businesses whose lives don't change at all in terms of what's happening globally, right? In fact, some of the policy pivot I was talking about only benefits them, right? So what I'm just saying is that right now we are, from a fundamental point of view, there are many sectors where the environment is in fact turning a little bit more positive than negative. But markets are kind of ignoring that, given the sentiment, given the fear, given the sort of panic in the market, and hence one is getting those kind of companies at a reasonably good price, right? So according to me, BFSI, pharma, CDMO, domestic consumption stories, industrials, they are unlikely to be impacted in the current scenario. In fact, some of them are only benefiting positively. Sector like IT can get impacted negatively if the US growth slows down. The fact is that we don't know today that whether US growth will slow down or not. Right now, we are in a period of flux. Depending on what policy will be implemented, we will know whether US slowdown will or not, and then eventually IT will slow down or not. So there's no point in reacting to the sector and arriving at a judgment that IT will sort of get negatively impacted. Right now, we are only talking about potential US growth slow down. We don't know yet because we don't know the policy yet, how they will settle. And a lot of outcome will be determined on that. But, of course, IT can potentially slow down. But again, according to us, it will not be structural in nature. Like I was saying, if let's say policy gets implemented, interest rate cut cycle activated in US, whether 2 quarter, 3 quarter down the line, if US Fed starts cutting rate, again, we'll be talking about growth. We have seen how IT stocks, sort of do well post and interest rates cutting down. Many in some of our previous call, I have said that whenever you start cutting rate, Indian IT does well, right? So because that talks about the potential growth environment or spending coming about in that. So we will just keep a watch on that, but I mean just keep this perspective in mind that today most people have turned already negative big time on IT, saying the demand is gone. It's not gone. I mean, it's just that right now we will know in some time that what will happen. uh, Manufacturing sectors we spoke. So I think, and currently the way we are positioned is that, we are overweight BFSI, pharma, CDMO, industrial, where the impact is hardly anything. We have some companies in our portfolios like Shift and CBAP, where these companies have some exposure to it. Not 12% is total exposed to US. Some 12% of our portfolio companies in Shift strategy, which is largely manufacturing strategy, has some exposure to US. And right now our view is that nothing is majorly sort of negative impacted. But just to tell you that it's not that everything is kind of disposed towards US within the even overall export kind of thing. So I think right now the way we see is that this environment is likely to be like this. Um, of course, moods swings. We have seen how people have been fearful in last couple of days. Of course, today is a little bit more calmer, depend as markets have shown a little bit of comeback. But I remember when we announced this call yesterday, a lot of people were kind of reaching out to saying that what should we do, and so we said let's organize a call and share our view. There's a lot of fear in the market. I think idea is to remain calm, not get impacted by the noise. There's a lot of noise. Yesterday we saw that in US market, one small rumor was there, where that the tariff is paused by 90 days, and markets bounced back quickly, and which was denied by the Trump White House, and again markets tanked. So this is the kind of environment we are in, and with the advent of or with the exponential use of social media these days, it's very hard to differentiate what's the news and what's the rumor, and hence markets are kind of even swaying more to these kind of news flow slash rumors. So an idea is not to kind of get, I mean, if you're leveraged you should worry, reduce your leverage because one does not know, but otherwise just remain calm. Don't get impacted by seeing market ups and down. This is environment might remain like this for some time. But we all know from our experience that uncertain times are the best time for investing. The vintage makes a big difference in terms of your outcome. So I remembered similar kind of environment was there in January to June 2022. If some of you remember, post pandemic market started recovering in the second half of 2020. Market did well throughout 2021. Most people started getting convinced about the market only late 21 and deployed capital in the markets. And Ukraine war started in 22, and Nifty came down from 18,500 to 15,500. And that time I remember similar concerns were there. Geopolitical inflations will go high. And some people said oil will go to $200. There could be potential World War III, all kind of things. So when negative happens, we extrapolate on the negative side. When positive happens, we extrapolate on the positive side. And these days, these things actually, everybody gets the same information, same point in time. So the reactions are far more sharper, quicker, without giving you any chance to react, right? So, and I remember writing this note in June of 2022 that built this vintage, and we had done similar kind of note and call that point in time saying that, you know, in I think May or June, I don't remember exactly, but that uh, you know lot if you think calmly, calm and peacefully, there is not something materially wrong as far as India is concerned. Indian growth is solid. You might have a little bit of noise coming into the market because of global setup. Uh, Markets have ignored a lot of positive in the recent past, whether it was RBI's policy pivot, government cutting aggressive tax cuts on the direct tax up to 12 lakhs rupees. Our some of the numbers in February, tax collections of GST, electricity consumption, IIP numbers, all have been kind of very, very, robust and positive. So I would say that the loss positive happening, there's nothing to worry from an Indian economy perspective. Indian economy perspective, I said markets can swing short term up and down. Nobody knows. right? I can tell you, I don't see good news is that I don't see massive leverage even in the market, which can, which can kind of unravel the generally whenever leverage is a one more tool which, pushes market down. But thanks to SEBI, I think SEBI in last 4 or 5 years have come down, reduced the margins, increase F&O margins. So, today you can't do margin funding with, less than 50% margin, and only that to approved stocks. So, you don't have massive leverage in the system right now. And that is a good news, because leverage typically expounds the, or, sort of, increases the impact of, fall, because sellers come to cover their, loans. So I would say that I will just pause here, that right now we are in a decent situation, not to worry. uh, Not to worry. Be ready for a little bit, embrace volatility, be ready for a little bit of volatility noise, and don't react to every rumor you hear, every uh, uh, you know in times like this, these things just kind of, fly, and a lot of people tend to, sort of increase rumors as well and contribute to the rumors. At least we are being very calm. We are saying it's fine if short-term portfolio goes down. Be calm, react. I mean, there will always be time to kind of adjust in your portfolio. It'll work as usual, and that's what I would advise all of you to also see that. If you have more capital, use next 2 3 months, I mean till June, to systematically allocate capital. I am quite confident that this vintage, like just the vintage of 22, delivered a great outcome. This vintage again will be very very good. Indian earnings will grow at 14 15%. I don't have doubt in my mind. Indian valuations have come down. 17 18 times. Nifty earnings, mid caps, of course, are higher. We don't have to invest into crazily valued in mid caps. Many good quality companies have come down 40 50%. You have interesting names, you interesting ideas there. So I think those are the jobs which we all the time keep doing it, keep looking at ideas where, which are, unimpacted, which can continue to deliver. So yeah, so I will pause here and take questions. Feel free to, either put in the chat or raise your hand. Either way, it's okay. Yes, Pal. Mr.
Hi, sir. So the
Yes.
question was like, if we believe that the market will still be volatile in the near future, should we keep investing right now, or we just hold cash for some time and then wait for the opportunity? Because we are been investing since January and February. We have always seen whenever we are investing, it's going down around 10 to 15%. The Nifty is going 5%. My portfolio will be going to 8%, 9%, because the beta is higher in the mid cap and small cap, of course. But the thing is, if we know that in the near term there are some more events are left out, why are we still investing in the stocks?
Like I said, I don't know what events are left out. Tomorrow morning, if Trump, like as yesterday, there was a 90 days pause. So let's say tomorrow Trump says, okay, I am happy to sit across table and negotiate, and I withdraw my reciprocal tariffs. One announcement, tomorrow markets will be again flying. So the point I'm trying to say is that nobody knows that which side it will turn. I mean, unless somebody has, ability to read or know the policy or read the mind of Mr. Trump and figure out what can be done, then of course, yes. But I don't have that answer. So, like I said, policy environment right now there is unclear. So, hence it is better to, take 2 3, and these kind of things don't tend to sort out in a day or two. They take, months, and at times sometimes even years. But I would assume that the large part of the sensitive parts should be get taken care in next couple of months. That's the reason I was saying that next 2 3 months you can sort of systematically allocate your capital.
At the same time, I had last one question, that what if the Trump's policies is impacting India as well? Are we gonna churn our portfolio in our old strategies? Like, because the dynamics definitely would be changing if the global supply chain is affecting. So,
So I was explaining that, currently I don't see any major change disruption to our portfolio. But of course, we are studying all the time. We are in touch with our investing company. Some of the trends we're trying to study. If there is any need, we will do change. There's no question. That's the job, we have. And that not only in case of this time, even otherwise we do all the time that changes. So this time we are more agile, but generally also, if anything is changing in the environment, we have to attend to that.
Thank you so much. Thank you.
Yes, Rajesh.
Hello.
Yes, Rajesh, please go ahead.
Sir, as our Indian GDP part is only 2% of the exports to US, and we will be impacted less comparative to other our competitors, as our tariffs are also competitively low. But I want to know, and even by decrease in crude oil rates and weakening of dollar, also India will be beneficiary. But sir, I want to know that whether because of these tariffs and inflation in US, recession is everybody's perception is this, that receptions are about to be in US. So whether in what quantum will it US recession affect to globe and to India in particular?
So Rajesh, I think that's what I was saying in the beginning of my comment that we don't know whether US recession will come or not. It can happen, you know, if let's say the cutting happens and interest rate does not gets addressed, it can happen. But the good news is that India gets to benefit, even if overall US growth slows down, India gets to benefit from increase in the wallet share in the manufacturing of US because of the current, our tariffs are low. Secondly, US China is anyway, sort of the trade deficit has to go down. So India will benefit from that. But we don't know whether US will get into recession or not. That nobody has an answer. That we will only know. You can only say depending on the policy, you can make it out. But today we don't have the clarity on the policy. And they're not, I mean, there are a lot of dependent variables. I am sure US Fed will be very agile to make sure that US does not go into recession. Raman, I'll take one or two questions before, when Raman is getting ready. Are you still bullish on CDMO space? Yeah, very, very bullish on the CDMO space. It's one of the, we think that in next 5, 10 years, it's where IT was probably in mid 90s. We will see many large companies kind of getting created in that. We have very large exposure to CDMO space.
Hi, Vikas. Are you
Yes,
able to hear me,
yes,
Vikas?
I can. I can.
Yeah, yeah. Because actually, I have two, three questions from my side.
Just keep
One is
yes.
actually, as you are already during the course of our interaction, you are also mentioning there are so many good companies which are high value earlier, and now it has come to a very good valuation. Means time to acquire time type of valuations. So, if that is the scenario, are you planning to shift our entire profile portfolio into a new portfolio which are more attractive and more value bets as of now? That is my first question.
Go ahead with the second question, please.
Yeah, and the second is actually, even if you observe our own portfolio, there are so many are irrespective of last 1 week's market going down, we are already facing some resistance and we are continuously moving downwards last 2 3 months, at least 2 months. For those, is there any strategy because they are already hammered and they are severely hammering now also. Is there any strategy that you are going to remove those and put the new additions on those places? These are the two questions from my
I
side.
think so. Yes, sure. So, like I said, we keep reviewing each company time and again, and whenever we think there's a change in the business profile, we will switch. Otherwise, we will not switch. So, currently, we are evaluating a couple of companies which we think has become attractive, and saying that which companies we can switch into this. So, those switches we will do where the risk reward is favorable, given current whatever. Because some of the companies which we've been wanting to buy, right now the prices have come down and we are liking. So, we will make some of those changes. But again, it's again looking at where does the valuation of my existing portfolio. Suppose if my existing portfolio companies has become even more attractive, then why should I switch? So all those calls we will make, and we do make, and we will make in you know in near future. We are already making, and we will keep making on that.
Okay. Thank you. Thank you, Vikas.
Thank you. Arvind?
Yeah, hi Vikas. Can you hear me?
Yeah.
Yeah, because my question is, with this tariff issues, okay, India might not be as impacted about more than our neighbors, but what the neighbors start dumping their goods into India, I mean, how does that impact us? Because they would produce and they need to sell it somewhere, right? I mean, that has been one of the fears which we have been having. So, how do you sense that coming up?
No, I think so. I think, see, you have to also give credit to our government also. They are not sleeping. In fact, this government is very agile. In last 2 years, they have used aggressive non-tariff barriers to kind of protect against that. So, like, India has made BIS requirement, Bureau of Indian Standard requirement compulsory for pretty much everything. So, just like how US FDA has for our pharma, now whom to give, if Indian officers don't visit China to give BIS, how will they sell into India? So, you create, these are the non-tariff barriers you create. So I think Indian government has created a lot of non-tariff barriers. Why does toy anymore not come from China? Because you need BIS requirement. Why does footwear not come anymore from China? Because you need BIS requirement. So Indian government has really, really moved very well in terms of avoiding that, and that also pushed or gives incentive for people to put up capacities here. Just to give an idea, because of the BIS requirement, a lot of large scale capacities are coming in and around Chennai for footwear manufacturing, which employ 5,000, 10,000, 50,000 people, now which was not there before. So this is the kind of change which has happened. So this government is actually very, very agile and attending to. They know that this dumping cannot happen here. So it's again so that I would say I'm not worried as much.
Okay, okay, great, thanks. Would you have view on gold and silver? Because
Not really. I mean,
no,
honestly, not really a strong
no,
view.
no, no, the ones. Thanks, because I appreciate it. Thank you,
Yeah.
thank you.
Saket, please.
Yeah, Namaskar, Bhaiya, and thank
Namaskar.
you for the opportunity. Sir, when we look at market positioning itself in terms of stock prices, they always factor in the near probability. As you told very fast that as the news flow is there, the market starts factoring it in fast pace. So when we look at जैसे हम अभी जो thrust देख रहे हैं कि गवर्नमेंट की तरफ से जो कैपेक्स है उसी पर ही पूरा सिस्टम आज रिलाई कर रहा है बट जिस प्रकार से अंतरराष्ट्रीय सभी इकोनॉमीज मूव कर रही हैं उससे तो ये सफा समझ में आ रहा है कि एवरीबडी देर आर कॉन्ट्रैक्टिंग दे डोंट वांट द कैपेक्स फ्रॉम द गवर्नमेंट साइड एंड सेकेंडली हमारे जो यहाँ के कॉर्पोरेट्स हैं वो ऑलरेडी आप बता सकते हैं कि शेल में ही है एंड दे आर ऑल्सो नॉट ईजिंग अप और अपना पर्स नहीं खोल रहे हैं कैपेक्स करने के लिए so how are you taking this situation because this dodge part of the story from US is what the government of India is also implementing in terms of reducing their fiscal deficit. They are trying to put more pressure on states to do the capex, the front running from that side. That is very much evident in the last 2 quarters numbers and the capex part, whether the Jal Jeevan story or anywhere. Everywhere the government capex have been cutted. So इससे सर हमारी ये जो पूरी आत्मनिर्भर वाली स्टोरी है या जो हम जो
No,
फेस
I
करने के लिए तैयार रहते
understood.
थे कहाँ रहेंगे सर?
Understood. Understood. So I think first of all, there are two. I mean, in my opinion, there's a little bit of a wrong impression that capex is not happening, and yeah, because historically people say capex is not happening because the benchmark of capex is linked to the credit growth. That if credit growth is happening, it means capex is happening. Credit growth is not happening, hence capex is not happening. That's actually wrong way to look at. 2009 to 2012, aggressive credit growth happened, and we all know what kind of lending had happened. So this time around, capex is happening through internal accruals and equity raising. Right? I mean, I say this: if the biggest barometer of capex you should look at in the order book of the capital goods companies. You look at Thermax, you look at L&T, you look at ABB, you look at Siemens, you look at any large capital goods company, they have a huge order book, right? Now, that is an indication of capex. In fact, the order cycle has elongated. So India, I mean, this is a wrong notion created that capex is not happening, private sector is not doing. I too will tell you when we meet so many companies day in, day out, I don't know a single company which is not expanding. Every company comes with only aggressive capex plan. And I keep on asking, भाई आप equity से पैसा क्यों raise करो, debt से ले थोड़ा. So that's the point. So ultimately, the reason why you have this impression, or everybody has this impression, capex is not happening, because it is linked to the credit cycle. So, and government is spending, I think, post, of course, last year because of elections, central government spend went down on infrastructure, but it is right now picked up again. Other day, some company was in my office, they were saying now we are getting orders left, right, and center, payments is getting released. So, government is also very keen in pushing the infrastructure. In fact, little bit of constraint we have on infrastructure in the execution capacity. Today, even if you want to build, we don't have capacity to execute. Or most of the PPC companies are, I think, full in terms of execution capacity. So all those challenges are there. But net and I don't think, capex is a challenge. India is spending good amount of money in building roads, railways, ports, airports, everywhere it's being built. So I would say that, don't remain, keep this impression. Uh, Next, Siddhant.
Hello. Yeah, can you hear me?
Yeah.
Yeah. Sir, though it's a little uncertain question, but still, what is your view on pharma and IT sector with respect to tariffs? Do you think these two sectors may remain protected? So far, I think the consensus view is, pharma being an essential item and, long gestation period would see lower tariffs. And it is an industry which, cannot be replicated by the US, quickly just by the
Sure.
capacity addition. So, and second question is, pharma sector has not seen much fall. So, what should be one strategy, with respect to investing in more money in pharma stocks?
So, pharma, we are very positive. According to me, US has not levied tariff because US cannot afford to, levy tariff. And even if they would, the Indian company will pass on, because Indian companies don't make a lot of money in US exports with 15, 20, 25%, I mean, 15, 20% kind of margin range. I mean, most of the companies were bleeding till 3, 4 quarters ago on the US exports. So, US FD regulator had visited India 2, 3 years ago, trying to, woo these companies to do investments. So according to me, pharma is a good sector. It will grow. In fact, because of this current ongoing crisis, if stocks have corrected, they are good opportunity to buy. Uh, so we have a very good positive view on pharma as a sector, and we have good exposure as well. Uh, I will just take final question from the, and then I'll take some questions from the chat. Mr. Gayatri Kumar.
Yeah, hello. You're able to
Yeah.
hear me?
Yes, sir.
Yeah, so this is with regard to one of your AIFs where the third tranche is due. You will go ahead and plan for the collection of that, considering that deployment of funds is a challenge now.
Right now, deployment of fund is not a challenge. It is the sentiment which is a challenge. In fact, same stocks are available cheaper than what they were before. And like I was saying, I don't think, Indian fundamentals have changed. So we will continue to go ahead. I mean, anyway, I mean, our drawdown of the tranche was staggered 4 months and 8 months. It was time dependent. And of course, deployment call we will take. If somebody wants to even delay for some time, we will give that flexibility to them also. We have no problem with that. So if you want to delay for whatever reason by 1 or 2 months, we are happy to give you that flexibility as well. That's not a problem. But deployment call we will take, and like I said, we are not at all worried about long-term outcome of the Indian market. We are very clear that this vintage will be very, very good from a long-term outcome perspective.
Yeah.
Yeah. Mitali.
Sir, I'm a new investor with Carnelian. Can you hear me?
Yes, Mitali, please.
So I'm a new investor with Carnelian. So I've gotten the email for two routes. One is the STP route and one is the lump sum route. So which of the two routes would you recommend in these situations where we're looking at adequate fund deployment in the next 3 months?
I would say do STP over 3 months. You can do 15 days, you can do 1 month, depending on what your comfort is. Do STP. I think till June, you can, in my opinion, do good investments.
So it is through the STP route, then we can gradually invest.
Yeah.
Okay, thank you.
Yeah. I think somebody has a question in the chat. I'm just taking a few questions from the chat. I think view on IT I have already covered. I think Mr. Philip's question is that our performance in last 2 months since January, February has been bad in some of the especially the shift strategy. Yes, sir. Answer is very true. We have had some underperformance, but please understand this strategy has I mean, has delivered 40% CAGR. So this strategy also did very well. So when market starts falling, when mid and small cap starts correcting, they too tend to correct very fast. So even if we did some comparison from the peak of September 24 till now, if I were to take correction in the market and correction in our strategy, we are still doing better than the correction. So I think it is just the nature of the fall which has happened so sharply in the mid and small cap space. That's the reason you are, feeling that. And rightfully, I understand that nobody wants to see mark to market negative, but so I understand that. But all I can tell you that we are, very confident of our portfolio. It will come back. And again, I'm telling you, I remember distinctly June 22 was a period in that quarter. Our portfolio had underperformance of 6-7% underperformance, and negative was more. And I think in the second half of 22, it got covered. So I think we do not want to just react to environment. Of course, we are watching, analyzing every company, with minute details, whether they are good or not. If we feel that they're not, we don't mind even booking loss and getting out and moving to somewhere else. Because our thing is, if you realize something you made mistake, first thing is correct without, trying to defending it, just correct. And then, because once you correct, then only you'll be able to make it back. Right. So we are, at the top of it. Don't worry. Um, there's one question that China for last 20 years has not delivered any return. Can India go into that situation? I don't think, in my opinion, in the same period when Indian GDP in last 20 years has delivered, or Indian markets have delivered almost 16-17% CAGR. China is a very different setup. Chinese banking system is completely, in my opinion, unclean because they don't have any. If today you were to do what India did, AQR asset quality review in 2014, if they were doing banking in China, I think, in my opinion, Chinese economy banking system will collapse because there is no concept of quality there. The ROE return profile is not even sort of bothered there. So India's ROE is far better than China. So India is a very different setup than China. China is more command and control economy. Their true wealth is created in terms of $3 trillion of forex reserves. That is what I think they don't focus on, in my opinion, too much on the market led. And it's not open market as well, except Hong Kong and Chinese market is also not open for foreigners. So I think, it's not comparable. And I continue to believe that India will be one of the best market in next 5, 10, 15 years. I mean, I just said, I do have positive stance on Indian equities. I think I pretty much taken most of the questions, I'm assuming. I think there's one question for dollar-based investor. There's a currency risk as INR keeps falling steadily. Is there being benign neglect of exchange rate for competitiveness? So I think one thing I must say that if you were to take short-term view, I don't know, currency can go up and down. But if you take 3-5 year view, see, Indian current account has got repaired and is getting repaired. In next 3 to 5 years, Indian current account will deficit will become surplus, and because of that, our currency will only get stronger. Historically, whenever the reason why our currency depreciated by 5% or 3, 4, 5% every year, because we had always current account deficit, and sometime depending on and which was needed to be funded through the current account, capital flows. The moment capital flows sort of become volatile, you start seeing uh, currency depreciating. But if your current account deficit is already not there, then you don't need dependence on the capital flows. And so as a result of that, I think, in my opinion, currency will not depreciate significantly. But intermittent short term, if you were to take 5 years, I would say currency will be more closer to 80 than closer to 90 is my view. But, I may be wrong. I'm no big expert on currency. Um, I think FIs will come back, in my opinion, in line with when Fed rate starts coming down. Whenever US cuts rate, money goes towards emerging market. Whenever US raises interest rate, money comes back from emerging market. So that is what we were seeing. Outflows were linked to US raising rates, and whether it happened 3 months, 6 months, 9 months, I don't know. Like we discussed earlier, uh, Trump has been pushing Fed for the interest rate cut, which is right now not happening. But let's see. We will know. But whenever that comes, it will come in hordes. As much as that we will not be able to handle that, in my opinion. But we'll see that. Likelihood FTA with you. I mentioned in my comments that soon we will have bilateral trade agreements with many countries. It's in the works. And yesterday, one of my co-founder met Piyush Goyal. He was hinting that they are working very aggressively on doing BTS with US and Europe. So let's hope. I'm sure our leadership is very responsible. Like how they managed the crisis during the Ukraine war time better than anybody in the world. Imagine if we did not import Russian oil, how our economy would have gone for toss, right? So I think fortunately we have a decisive leadership, a statesman leadership, which is working behind the door to make it happen rather than just kind of go open and address, take those kind of things. So I think they know what to do. And I am quite confident that I'm sure they will navigate us out of this crisis also reasonably well. So good. I think we have had a lot of good discussions. I am not able to take some stock specific questions. I'm sorry for that. But we've completely run out of time. So thank you very much for your participation and patience. Look forward to, and if you have any more questions, please, if you have our numbers, please feel free to sort of contact me, contact Tanay or any of us, any of our partners. We will be available. Sure. Thank you very much.